Since our last FOMC meeting, there is no big change in this graph. And main thing is, before this FOMC meeting, we all know that in the news everyone was saying 6% terminal rate, and Fed in his speech before FOMC meeting said he can hike up to 50 basis point. But thing changed. He hiked only 25 basis point, and before FOMC meeting some investors were expecting 25 basis point rate cut, while in Feb FOMC meeting just before that 500k NFP, same market was expecting 0% rate hike, that's mean rate pause, and that market pricing for March FOMC decision from 0% to 50, that was big change, and from 50 to 25 basis point rate cut, that was also a big change. But before you say that interest rate can go up to 6%, first you have to understand difference between these three. CPI mean maximum Fed interest rate can go, which is now 6%, and in future CPI will only go down. It can go to 4% or maybe 5%. But one thing is certain, in future this will be lower than 6%, and beginner trader are always panic about this CPI number, because this rate hike cycle is purely based on inflation control fight. So CPI was most important news last year 2022, but this year 2023 things are different. And second thing is core PCE, and biggest confusion among beginner trader, and all the news company exploit that information. Fed official target is PCE number. Fed has said many times that he think core PCE number is best way to predict inflation in US economy. So core PCE means Fed interest rate. And now you can see Fed interest rate is now above core PCE number. That's mean real interest rate. That's mean Fed inflation fight is already over, because real rate are now positive. And since for next FOMC meeting May, market is expecting 0% rate hike, that's mean interest rate pause, and in June FOMC meeting they are expecting 25 basis point rate cut. And if you see, if interest rate stay at 4.75, that means rate pause, then you can see this line will be horizontal, there will be no change. And if they pause interest rate, CPI will come down and it will be lower than Fed interest rate. And this week on Friday you have core PCE number, and either it comes down this week or next month, but in future that number will be lower. So in case of rate pause, if they hold interest rate on this current range 4.75 to 5%, then core PC number is already below interest rate and it will be more lower than interest rate. So in that condition, let's say near July FOMC meeting or maybe September FOMC meeting, Fed interest rate will be higher, more than CPI, more than PCE, more than core PCE number. That is why that market pricing for rate cut is too early. And this is same like people who were expecting rate pause in March FOMC meeting before that 500k NFP. Because I think Fed will wait for CPI number dropping below their interest rate, then they will start cutting interest rate. So until interest rate line cross these inflation number, do not expect rate cut, and that is why they are pausing interest rate. And second thing, their inflation target is PCE number officially, and that was 2%, but because of this stagflation, inflation target will change, and unofficially it is right now 3%. And Fed always say core PCE is best way to predict PCE number. So by the time core PCE number hit 4% or less than 4%, that means 3%, then we can say rate cut is coming. So rate pause in May FOMC meeting is reasonable, but cut in June FOMC meeting may be wrong. And to watch this Fed interest rate line crossing CPI and core PCE both, we have to wait till July or September FOMC meeting. And that is why expectation for rate cut in December FOMC meeting is right choice. And one more thing I would say, that interest rate stay there because of last rate hike in March FOMC meeting, and CPI and core PCE number. And ultimately, if inflation become under control with 4.75 interest rate, then they do not need to hike up to 6%. And many macro traders are still predicting that 6% interest rate, because ultimate goal is to create recession, and if recession can come with 5% interest rate, then they do not need to hike up to 6%. Instead of focusing on a fixed number, you should focus on crossing of these line. And by the time investor get confidence that in next month CPI number will be below Fed interest rate, then that will be time for rate cut. And now if we see their statement in this FOMC meeting, then first one which I think is important, then they said they will keep reducing balance sheet as planned. So QT means tight monetary policy, and if you read books and do macroeconomics course, then according to rules there is a rate hike, and by rate hike they control inflation because that brings recession. But that balance sheet reduction is new concept. If you read books, then you will not found that concept in books. So balance sheet reduction is also another form of rate hike. If Fed pause interest rate in May FOMC meeting and they keep reducing balance sheet, that will be also something like 25 basis point rate hike. But confusing thing is, before FOMC meeting this week, their balance sheet size increased once again, and now they are saying temporary. So increase in size of balance sheet means indirectly rate cut. That means more inflation. And if this is not temporary, that means size of balance sheet will decrease again. That means indirectly rate hike. But these things will be clear around July or September FOMC meeting. Because I don't think this is temporary, this is permanent, and their balance sheet size will only increase. They tried in 2018, failed, and they tried again 2022, failed, and no investor will wait for their third attempt. And another statement from Fed was getting inflation back down has long way to go. And he is repeating many times this line, long way to go, because this is stagflation cycle, and if they really want inflation back to 2% target, it will take many years, something like 2030. By the time they declare stagflation, it will be too late. And investing asset like gold to avoid that stagflation that can hit more than $3,000. And another statement was, he said economic data came stronger than expected since last FOMC meeting. So this week was March FOMC meeting, and before that was February FOMC meeting, and we all know that 500k NFP came after Feb month FOMC meeting. And that is why he said that in March FOMC meeting they could hike up to 50 basis point. But because of banking crisis, because before March FOMC meeting there was his speech, and in next day we got bank run news. So basically you say every time he give his speech, few days later another news came and his decision goes in opposite direction. So now he is saying tighter credit condition. This is another name for that bank run crisis, because banks are collapsing. Because of credit tightening, there could be less work for rate policy. Credit tightening. So indirectly they are doing rate hike in two others way. So if they pause interest rate, then still they will be doing rate hike indirectly in two other form. And another key statement which came, that their decision will be based on totality of data. That is same word he used before March FOMC meeting speech. Because right now Fed monetary policy decision in this rate hike cycle depends on NAP and CPI. And when he say totality of data, that's mean other economic indicator, other news more than NAP and CPI, they can change his monetary policy decision. And if in upcoming week a new bank collapse, then he can ignore NAP and CPI and he can change his monetary policy decision. That is why he is again using that word second time. He repeat again soft landing, that soft landing is possible, because in 2021 he was repeating inflation is transitory, that means CPI increase is temporary, and now in 2023 he is saying soft landing is possible, that means recession will come, but that will be soft, that nobody will feel. So every time he repeats soft landing, same like transitory inflation, investor will speculate more and more against recession. And another important statement was, he considered rate pause. And why he is doing that? He explained that balance sheet reduction and credit tightening that will be replaced by rate pause. This year 2023, if soft landing is one thing, then another thing is he said they don't see rate cut this year. This is same thing. They hike interest rate in 2022, started with 25 basis point and went up to 75 basis point. But in 2021, they said same thing that they do not see rate hike, and now they are repeating same thing for rate cut. So their language is different, but he is giving signal for rate cut this year. And market is always greedy, so he is expecting rate cut in June FOMC meeting. And another thing he said that before banking stress, that's mean before we got bank run news, they were thinking about raising terminal rate, and terminal rate hit up to 5.75 in Fed watch tool. So he is saying because of that bank run, because of credit condition are tightening, they are not thinking about increasing terminal rate, and it is same as in December FOMC meeting 5.1. So since December FOMC meeting last year, there is no change in terminal rate, and they are talking about rate pause, and also they are talking about rate cut. So he is giving signal for rate cut. And another thing he said, he is well aware of concentration in commercial real estate, and he think it is not as dangerous as other banking problem, something like bank run. But we all know since 2009 that real estate market is running on 0% interest rate. So don't be shocked if something repeat like 2009. And these two statements that he said we need to raise interest rate higher than expected, then we will. One side he is saying that terminal rate is same as last year December FOMC meeting. Another side he said they consider rate pause. And another side he also say they do not see rate cut this year. Same like they did not see rate hike in 2021. But he also repeating that they can hike rate higher than expected. These are confusing statements that news company will try to confuse you. And I think most important thing in all of these statements, soft landing and don't see rate cut this year and balance sheet expansion was temporary. These three things are important, because if this is not temporary, then QE monetary policy is already started. Because when they end golden standard in 1971, in beginning they said same thing that it is temporary, and now they are printing non-stop. That time gold was fixed at $35, but in their last QE monetary policy gold hit 2075. So I do not believe that this is temporary, it is permanent, and new high in balance sheet size is coming. And you as a beginner trader, Fed has given open invitation for rate cut market speculation. Why not increasing terminal rate? And final warning before rate cut will be rate pause, and he will announce rate pause in May FOMC meeting. And if these two things change, credit tightening and balance sheet reduction, these two are indirect rate hike. And if you see statement of Bank of England governor, he is hopeful that UK will not enter a recession now. And if you have studied economics, then you know this is not possible. Even if Bank of England do nothing and they pause interest rate, then they are part of globalization, and all the central bank together are hiking interest rate, especially Fed whose interest rate are now 5%. And when US will go into recession, they are not alien and they do not live in another planet. They cannot avoid recession. And not just the central bank, all the government employee who make fiscal policy or who makes monetary policy, US, UK and Germany, that's mean Euro area, all of them together are repeating same thing again and again every day, that this is not 2008 crisis, and they are saying that 2008 banking crisis will not repeat and UK banks are much stronger. Germany are saying same thing, UK are saying same thing, and US government is already saying same thing. And since blackout period is over, now they will speak every day and confuse you by giving their fake forecast. Because that person who recommended 7% terminal rate is now saying that today's situation is vastly different from 2007 to 2009. And all of these central bankers are planning same recession which we saw from 2007 to 2009. They are giving signal indirectly, and their goal is to replace inflation with recession. And when these central bankers together are planning same recession like last time, then you know whatever will come in 2024, it will be bigger than Great Recession. And I think you will get mini depression this time, because euro area inflation cannot be solved without depression. And basically you can see since 2009 to 2021, that is very long time, and this economy like euro area, US and UK, they are running on 0% interest rate plus money printing, and that monetary policy has created huge asset bubble, and they want to end that bubble. That is why they are again and again every day are saying that this is different from 2007 to 2009, and this is famous line of central banker, that this time is different. And since this is stagflation cycle, inflation will never go back to 2%. After temporary correction in CPI, it will make new high and it will keep doing for something like 2030. That is main thing about stagflation.